Welcome to the Deep Dive. Today we're plunging into a story that's actually unfolding right now. It's Friday, August 8th, 2025. And the trade desk TTD, the big digital ad tech company, they just released their Q2 earnings. And here's the kicker. The numbers look pretty good. 19% year-over-year revenue growth, hitting $694 million. But the stock price, it's absolutely tanked. We're talking over 37%, down in just one day, from about $88 down to 55 inches. People are calling it their worst drop ever. And analysts, they're just rushing to downgrade. It's wild.
It really is. And that paradox is exactly what we want to dig into today. You've got this company, strong business model, really innovative tech. They even just got added to the S&P 500. So how does that company see its stock plummet like this? Our mission here for you listening is to get past those flashing headlines. We'll look at the actual business TDD strategy and maybe figure out what this big drop signals about digital advertising overall. It's about finding those aha moments the news cycle often skips.
Okay, good plan. And just quickly for anyone less familiar, the Trade Desk, founded back in 2009 by Jeff Green and David Pickles, based out in Ventura, California. What they do is run this big cloud-based platform for buying ads, self-service. Think of it as helping advertisers buy ad space across the whole open internet, not just on one site. They handle targeting, measuring results, optimizing campaigns, the whole shebang, buying ads smarter, basically. All right, let's get into the shockwave. The earnings versus the market crash. First, the numbers TTD reported for Q2 2025. Like I said, they look pretty solid. Revenue. $694 million, up 19% year over year. And apparently, if you take out the U.S. political ad spend from last year, Q2 2024, that growth is closer to 20%.
Right, so the top line looks healthy, and their adjusted EBITDA, that's a key profit metric, earnings before interest, taxes, depreciation, amortization check, it came in at $271 million. That's like 39% of their revenue, which is a strong margin.
Very strong. And the adjusted net income was $203 million, about 0.41 cents per share. They've got cash, too, $1.7 billion on the balance sheet, plus $117 million in free cash flow just in the quarter. And they even gave guidance for Q3, expecting at least $717 million revenue. That's 14% growth, or maybe 18% if you, again, exclude political spending comparisons, and $277 million in adjusted EBITDA. So looks okay going forward, too, right?
You'd think so. But then, boom, the market just delivered this absolutely brutal verdict. August 8th, stock falls over 37%. Ouch, MarketWatch was reporting analysts asking, wait, is Amazon somehow involved?
Yeah.
And the downgrades just piled up immediately. Wedbush outperformed down to neutral. Price target cut to $68.
Cool.
Moffett-Nathanson. Neutral straight down to sell. Target price slashed to $45.
Wow.
Citigroup. From buy to neutral, target $65. And BofA Securities actually hit them twice. One downgrade buy to underperform, another buy to neutral. Both with a $55 target.
That is just a cascade. So it begs the big question, why? Why such a vicious reaction when the financials seemed, well, decent?
Exactly. And that likely brings us to the core conflict here, the philosophical difference, maybe. It's about how TTD positions itself versus the competition.
Which is?
Objectivity. That's their keyword. They stress that their platform helps advertisers buy ads anywhere on the open internet. Critically, TTD doesn't own the websites or apps where the ads run. There's no thumb on the scale, as they put it.
Okay, so they're like a neutral marketplace, unlike the walled gardens.
Precisely. The walled gardens, think Google, think Amazon. These guys own the ad platform and the places where the ads show up. Google has search and YouTube. Amazon has its site and Prime Video, for example. So TTD argues they have an incentive to push advertisers towards their own stuff. They kind of grade their own homework, which TTD says isn't transparent or objective for the advertiser.
Right, that makes sense. You want the ad broker to be impartial. But back to Amazon. The analyst mentioned them. How does TTD see Amazon? Are they a direct threat?
It's nuanced. TTD's view seems to be that Amazon is mainly focused on selling its own ad inventory, especially things like Prime Video, apparently. The amount of ad space there nearly doubled recently. So TTD sees Amazon less as a direct competitor in the open internet space where TTD plays, and more as, I guess, a potential partner. If Amazon ever decided to let TTD's advertisers buy ads on Prime Video.
Interesting distinction. So TTD's focus is firmly on that open internet outside the big walls.
Exactly. And they see a massive opportunity there. They call it the big pie. Their argument is consumers spend most of their time online on the premium open internet reading news, watching streaming TV shows on various apps, sports, music, etc. But a disproportionate chunk of ad money still flows into those walled gardens. TTD believes they can capture a much bigger slice of that pie by offering objective, performance-based buying across that open space.
Okay, so that's the strategic battleground. What about the tech? What's under the hood that lets them compete? You mentioned innovation.
Yeah, absolutely. The big thing here is Kokai, Kokai. That's their major AI-powered platform upgrade. Think of it as the new brain of their system, and adoption's been really fast. Over 70% of their client spending is already running through Kokai. They expect everyone to be on it by the end of this year, 2025.
And does it actually work better? Is there proof?
Seems so. They say clients who switch to Kokai increase their spending on the trade desk 20% faster than those who haven't switched yet. So it seems to be encouraging advertisers to spend more, likely because they're getting better results.
Any specific examples?
Yeah, they shared a few. Samsung over in Europe apparently saw a 43% improvement in reaching their target audience using Kokai. And a company called Cash Rewards in Asia got a 73% improvement in their cost per acquisition. That's huge. Generally, they claim Kokai campaigns perform over 20% better on key metrics, KPIs, compared to the older system.
So what is the AI doing? What's Koa?
Koa is the AI technology itself, embedded throughout Kokai. It powers things like better forecasting, predicting ad prices, and availability. It helps optimize campaigns automatically, finds the most efficient supply paths to buy ads, and handles something called predictive clearing, which is about bidding smarter. Their core belief, which they state often, is quality AI requires quality data.
Mm.
And TTD processes just a staggering amount of big data, which fuels Koa. The CEO once said they do as many transactions in 30 seconds as Visa and MasterCard do in a whole year. Just
Yeah.
imagine the data flow.
Okay, so Kokai is the AI brain. What else are they doing on the innovation front? You mentioned the supply chain.
Right. They're trying to make the whole process of selling ad space more efficient and transparent too, not just the buying side. One tool is called OpenPath. It basically lets publishers, the websites, the apps, connect directly to the trade desk's platform. This cuts out some middlemen, gives publishers clearer signals on what advertisers are willing to pay, and gives the advertisers, TTD's clients, more direct visibility into where their ads are actually running.
Any results from that?
Yeah, they cited the New York Post seeing a 97% jump in revenue from programmatic display ads using OpenPath, and Hearst newspapers apparently saw their fill rate, how much of their ad space gets sold, improve by 4 times.
So it's cleaning up the connections. What about knowing the quality of those connections?
Good question. That's where Sincera comes in. TTD acquired this company, Sincera. Sincera provides data specifically focused on the quality and transparency of the ad supply chain itself. And TTD is actually offering free access to a lot of this data through something called Open Sincera. The idea is to help publishers see where they can improve their ad setups. And importantly, that Sincera data also feeds back into Kokai, helping the AI value individual ad opportunities better.
Okay, makes sense. And there was one more tool you mentioned, Deal Desk.
Yeah, Deal Desk. This one's still in beta, but Disney is an early adopter, which is significant. It's an AI-powered tool designed to help advertisers and publishers manage those direct advertising deals they set up. You know, the pre-negotiated agreements for specific ad space or audiences. Deal Desk uses AI forecasting to track if those deals are delivering as promised, if they're pacing correctly. And if a deal is underperforming, it can suggest alternatives, maybe shifting budget to the open market or other premium options available through TTD. It's interesting that Disney has a public goal to shift 75% of its own ad revenue to programmatic buying by 2027. Tools like Deal Desk seem key to that.
All right, so a lot of tech aimed at efficiency, transparency, and performance. Where is this translating into growth? Which specific areas are really driving TTD's business forward right now?
The biggest one, hands down, is connected TV, CTV. That's their fastest growing channel. They said CTV-led video, which includes other online video too, now makes up a high 40s% share of their entire business. That's nearly half.
Huge. And who are they working with in CTV?
All the big names, really. They highlighted partnerships with Disney, NBC Universal, Walmart Connect, Roku, LG, even Netflix's ad tier. And they're building specific tools for it within Kokai, like being able to target ads around key moments in live sports. Imagine placing an ad right after a goal or during overtime. That's pretty powerful for brands.
Definitely. What about other growth areas besides TV?
Retail media is another big one. This is using retailer shopping data to target ads, both on the retailer's site and off-site. They reported record spending influenced by retail data running through their platform. That includes activity on the Walmart DSP, which TTD powers, and they've signed new deals with companies like Instacart and the UK grocery giant Ocado to get access to more granular purchase data, which makes the targeting even better.
Okay, CTV and retail media makes sense. Anything else structurally driving growth?
Yeah, something they call joint business plans, or JBPs. These are basically strategic, multi-year commitments between TTD, major advertising agencies, and the big brands themselves. They said the number of these JBPs is at an all-time high, with nearly 100 in progress. And crucially, the spending growth coming from clients involved in these JBPs is significantly outpacing the rest of their business. It locks in commitment and deepens relationships.
Interesting. So building long-term partnerships, you also mentioned some leadership changes aimed at strengthening operations.
That's right. Seems like a focus on operational discipline as they scale. Alex Kayal is stepping in as the new CFO starting August 21st. He's actually been involved with the company for a while as an early investor and board member. He takes over from Laura Schenkine, who is CFO during their big S&P 500 inclusion moment. They also brought in Vivek Kundra as Chief Operating Officer back in March and added Omar Tawakkol, another known name in ad tech innovation, to their board of directors.
So bringing in experienced hands, and related to leadership, you touched on their share structure, the dual class thing.
Yes, they're proposing to extend their dual-class share structure. This structure typically gives founders or insiders more voting power per share than public shareholders. The rationale they give is that it helps maintain a long-term North Star orientation. Essentially, it allows the founder-led strategy to continue without being overly swayed by short-term market fluctuations or pressure from activist investors. They point to their growth from under $1 billion market cap at IPO in 2016 to around $40 billion today as evidence that this long-term focus has worked.
Right, shielding from the kind of pressure that might cause, say, a 37% stock drop after decent earnings.
Exactly. It's designed to let them execute their long-term vision even when the market gets spooked.
Which brings us back to the current environment. How are they addressing the broader economy? Things like inflation, potential recessions, tariffs. You heard those might be impacting advertisers.
They definitely acknowledge the macro pressures. They mentioned tariffs specifically impacting some large auto and CPG consumer packaged goods brands, and those are big categories for TTD. However, their counter-argument is sort of counterintuitive but interesting. They argue that economic uncertainty historically accelerates the shift towards programmatic advertising, like what TTD offers.
Not so.
Because when budgets get tight or the future looks uncertain, advertisers demand more control, more flexibility, and crucially, more measurable results. Programmatic advertising, by its nature, offers that agility and performance data. You can adjust spending quickly, target precisely, and see exactly what's working. So while headwinds might hurt overall ad budgets, the uncertainty could actually push more of the remaining budget towards platforms like The Trade Desk. That's the theory anyway.
Okay, so wrapping this up, we've seen this stark contrast, haven't we? On one side, this dramatic, almost panic market reaction to the latest earnings and guidance, a massive stock drop. On the other side, you have the trade desk itself, projecting confidence, talking about its long-term vision, a vision rooted in being the objective platform for the open internet, powered by increasingly sophisticated AI like Kokai and expanding in key areas like CTV and retail media. It really highlights that tension between Wall Street's immediate reaction and a company trying to build for the next decade of digital advertising.
It absolutely does. And it leaves us with a really provocative question for you, the listener, to think about. We're in this world increasingly shaped by AI and oceans of data. The line between just building brand awareness and driving actual sales is getting blurrier and blurrier. So where will advertisers ultimately place their trust in their trillion-dollar budgets? Will it be inside those controlled, perhaps inherently biased, walled gardens, or will it be on the open internet, the transparent, measurable, constantly optimizing landscape that the Trade Desk is championing? What stands out to you about this whole dynamic? What part of this evolving ad world will you explore next?